In my previous videos, I've talked about how money is fake and yet people still use it to measure value, which is what causes people to make poor financial decisions both in their personal finances and in their business finances. People often think that understanding value is incredibly difficult, but in my experience, simple math and quality execution trumps complicated math all the time. In this video, I'm going to talk about how to calculate value in your daily decision making. We're also going to talk about how it gets more complicated when you introduce the idea of debt and investments. Guys, if you don't know me, my name is Austin. I just started a financial education company. My goal is to help 1,000 people attain financial security with a focus on wellness. And if I do 1,000, I'm going to do 10,000. So how do we measure value if not with dollars? There are 3 quick ways. Number 1, how many hours would it take me to make that amount of money? If you're a salary worker, remember that this is your hourly wage minus your expenses and all the things that you have to spend money on in order to get to work, like driving to work, tires, car repair. Because people have different income levels, this amount is going to be different for different people. But it's a really great way to decide whether you should do your own landscaping or pay someone else to do it. Also consider how long it would take you to do the work versus how long it would take somebody who's a professional. And 2, are you able to make more money in that time doing something else? If you have a traditional 9-to-5 and you don't have any other opportunities, even if you make $100 an hour at work and it would only cost you $50 an hour to have someone do your landscaping on the weekend, still might make sense for you to use those hours and do the landscaping because you don't have any work on that particular day. Number 2 way that I measure value in a thing is to what degree will that thing actually improve my everyday life. This is where people get stuck a lot of the times because see, there's a disconnect between what you think it will do versus what it will actually do. It's not your fault. Basically, all of marketing is designed to tell you how an item will improve your life when the reality is it really won't. One of my favorite examples of this is a guy who made a video about how he thought it would be awesome and his life would be so much better if he got a GoPro. But then he realized that he was taking a bunch of GoPro videos of himself sitting on the couch. So your life actually has to be cool before you get a GoPro, and then the GoPro will make it cooler. Personally, I play my guitars daily for hours a day. So it's really worth it to me to have nice guitars and spend some serious money. But see, I didn't start with expensive guitars. I bought one that was fairly cheap to try it out and see how that was actually going to affect my life. Turns out, I can't put the thing down. I play it all the time. Years later, I started to get pretty good at playing the guitar. It makes sense for me to get one that's pretty nice because the use that I get out of the tool is immense and it's more than what it cost me to buy the thing. A big thing to think about that a lot of people don't consider is what are the ongoing costs of my purchase versus the immediate costs. See, I'm super into mountain biking, and mountain biking in my area is a pretty cheap hobby ongoing. Now, if you're buying a nice mountain bike, you're gonna spend quite a lot of money, like several $1,000s on the bike up front. But ongoing, very low cost. Mountain bikes almost never break down and you don't have to feed them with gas. On the other hand, motorcycles are incredibly expensive, especially KTM motorcycles for off-roading like I enjoy. My bike is one of the lower cost KTMs to ride, it's KTM 1190, but I gotta do oil changes every 3,000 miles, tire changes every 3,000 miles to keep my good off-road tires on there, gas every time I ride. The rear wheel is constantly leaking, so like once a year I gotta pay somebody $250 to fix that because it's too hard for me to do with my tools at home. Helmets get worn out. Riding gear. Not just riding gear, but you have to have a riding gear for multiple seasons because you're exposed to the elements. So you have to have winter riding gear, summer riding gear. And even after you buy all that stuff, you don't get that many opportunities to ride because so much relies on the elements and the weather and the time of year and the amount of time that it takes for you to go out for a ride. So you have to go much farther to do a motorcycle ride than I have to go to do a mountain bike ride. This is all not to mention all the time that I spend riding a motorcycle that I could be spending on my business and the opportunity cost of my time going to that versus building a business. I'm not saying you shouldn't get motorcycles or you shouldn't have big expensive hobbies. I'm not getting rid of my bike anytime soon. All I'm saying is evaluate all of the recurring costs of a hobby before you decide to get into it. Oftentimes you will find that it's just not worth it. A strategy for managing all these things is to actually get out a spreadsheet and assign values to each hobby. How many hours will you actually spend doing the thing? And how much joy do you actually get from each of those hours? Don't just think about it, actually assign it a number and put it on a chart. Also add the opportunity cost to that chart. How much money could I make if I just played the guitar like 1 hour less per day? It's mind-blowing. Metrics like these are how we run our businesses day to day, so why not run our personal lives, our hobbies, and our relationships that way? Here's how stuff gets more complicated when you introduce the idea of debt and investments. You gotta understand that recurring dollars are actually much more valuable than a lump sum. Would you rather have $72,000 for a one-time project, or would you rather have $6,000 a month recurring for a 12-month contract of recurring services? In this case, it would seem that the values are the same. So why wouldn't you want the $72K up front? The reality is that the customer is much more likely to renew the contract at the end of 12 months of good service. They're also much more likely to buy upsells and cross-sells throughout the life of a 12-month contract. Also, at the end of the contract, they've worked themselves to a place where your business is a vital part of their business. So it's quite painful for them to extricate themselves from that. People avoid pain constantly. It's also much less costly for me as a business owner to deliver a regular recurring service than it is for me to get everybody together and manage a one-time project. Now, how can we use this information to also affect our personal finances? Here's a big one. You are more likely to accurately value your time and work and energy when you've already done the work than when you're talking about future work. See, people tend to have a positive outlook on the future while they have a negative outlook on the past. Predatory lenders rely on this fact when the reality is that the dollar is actually getting less valuable over time and incomes are not keeping up. So it's actually going to take more work and be more painful for you in the future to make those same dollars than it was in the past. This is why we have to think about these things before we click on that button that says make it in 4 easy payments. So the next way we can apply these ideas to our personal finances is that understanding inflation and supply and demand can help you make accurate evaluations of your investments when other people are not able to. Story time, I bought a house in February of 2023. Everyone was saying that it was a bad idea. Interest rates were at like 5.5%, and everybody was saying that that was very, very high because recency bias had told them that interest rates were going to be 3.5%, even 2.5%. Because of the fact that everyone thought interest rates were very high at 5.5%, nobody was out there buying houses. When just a year prior, massive corporations had been gobbling up all of the real estate that they possibly could have. So I actually bought my house from Opendoor. See, 1 year prior, they had bought this house for $350,000. They listed it for $380,000 or $390,000 or something like that. But then slowly over time, every month it was on the market and wasn't selling, they had lowered the price and lowered the price till it was down to $320,000. They were losing money on the deal already, and it still wasn't selling. See, $320,000 was actually a pretty good deal on the house at the time. But I knew a couple of things. I understood supply and demand, I knew my situation as a home buyer, and I knew Opendoor's situation as a real estate investor. I also knew that interest rates were going up, and they were going to go up much further. I ended up offering them $280,000, a whopping 40 grand less than what they were asking, and they accepted. See, Opendoor is actually not too stupid either. Now it's almost 2 years later and I'm pretty happy with that move. See, interest rates are back down to 5.5%, which is where I bought at, but the house is still worth $320,000 instead of $280,000. For a brief period of time though there, it did go down and it looked like it might go down much farther. So when I made my offer of $280,000, I was leveraging my position both as a buyer in a buyer's market and as an individual who understood that I was taking on the risk that housing might drop more significantly than people thought. So I got a discount. So, conclusions about value. Number one, it's important to accurately evaluate your spending and value the things that you buy based on how much time and energy it takes you to acquire those things. Number two, understand inflation. What something is going to be worth in 2 years is much different than what it's worth right now. When you take on debt, you're selling your future productivity at its current value. But working will actually get harder over time. When you buy depreciating things on debt like cars, this is exacerbated even worse because, see, the value of your time is going down and the value of the thing that you bought with that debt is going down also. It just amplifies everything. Number three, when investing, make sure you're getting a good deal. Not just a good deal right now, but a good deal that's going to be a good deal in 2 years and in 5 years and in 10 years. And leverage your position in the market to attain those deals. Guys, if you have gotten value out of this video, please share it with a friend or family member and see if we can't get the conversation going amongst each other about finances and getting ourselves into a place of financial security.